Hello, this session for Tolley Seminars Online is about the Budget 2014 announcements affecting personal tax. This is Rebecca Bennyworth. The first slide in your pack looks at the continuum that is the way we develop tax these days. So the budget just forms part of a continuous process. So what you'll see is that a number of the measures may already have been announced, either at the last budget or at the pre-budget report or Chancellor's autumn statement in December. And we may also be seeing some announcements that are going to affect the next couple of years. Turning to the personal tax measures. We already know that the personal allowance for 2014-15 will be £10,000. This was announced last year. Our current budget has announced that the increase in April 2015 will be £500, bringing the allowance to £10,500. This means that the basic personal allowance will be the same as the first level of age-related allowances, which were frozen as part of the granny tax measures a couple of years ago. This means that it's only taken a couple of years to work through that area of complexity with abatement of allowances for elderly taxpayers. The substantial rise in the personal allowance also means that the basic rate band will once again get smaller in 2015, even though the entry point to higher rate tax has gone up very slightly. We're increasing that entry point by 1% per annum, but because the personal allowance is increasing more quickly, we're actually seeing a narrowing basic rate band. As mentioned in the session on savings, the 10% tax rate has reduced to zero, and the band will expand up to £5,000, both from 2015. This affects the starting rate for savings and is not relevant to any taxpayers with non-saving taxable income in excess of £5,000. Other areas of tax allowance development already announced, the transferable allowance for married couples and civil partners. From 2015, they'll be able to transfer up to £1,050, 10% of their personal allowance, to their spouse or civil partner. It won't be available to anyone who pays tax at more than basic rate, but is obviously a useful option for some taxpayers with a partner who is not able to use all of their personal allowances. The final thing on tax allowances is an interesting announcement that the UK will explore the possibility of limiting the availability of UK personal allowances to non-residents. At the moment, there is a very wide range of people who get UK personal allowances, and we're going to explore limiting it to people who have a strong economic connection with the UK, although that term is not yet defined. Moving on to benefits in kind, we have some more changes for company car drivers, and none of them are good. What we'll see is the two segregated rates for very, very low emission vehicles, that is 75 down to 51 grams per kilometre and then 50 down to 0. They will see some quite substantial rises as we move through to 2018, with a 2% rise announced into 2017 and then a 3% rise from April 2018. The main table, which currently starts at 10% for emissions of 76 grams per kilometre and over, that will increase by a further 2% every year. So we do a 1% increase in April 2015, 2% in 16, 2% in 17, and a further 2% in 2018. So by then, the starting point for the table will be as high as 19%. So clearly bearing down more tax, and quite a lot of tax generated by this. For each increase, around about £250 million is generated in tax. Fuel and van benefits, the fuel scale is about to go up by 2% over inflation. I can't find a figure in the pack, but it's pretty likely that'll be 22,000. And then in 2015, we've now been told that both fuel benefits and the van basic benefit will all go up by RPI inflation as of September 2014. Those increases will be announced in time to code them in the coding round in January 2015. Finally, on benefits in kind, we've got information about where the OTS is going with their study of simplifying this area, and the budget pack sets out 4 areas for action, so more looking at how this will actually be achieved over the next year with a view to implementing it in a year's time. The 4 items are to abolish the £8,500 threshold so that all benefits are taxable on all staff. There's a mention of mitigating for vulnerable groups, but no definition of what that might be. A statutory exemption for trivial benefits rather than the non-statutory disregard that we currently have in the Employment Income Manual. Note that that disregard isn't currently an exemption, so bringing that onto a statutory basis I think is welcome. A voluntary payrolling scheme for benefits in kind. Some larger employers are very keen to move ahead with this, and it would be a simplification for them, and certainly provided it's not made mandatory, I think that's a welcome development too. Finally, dispensations will be abolished and they'll be replaced by a new exemption for reimbursed expenses, so that development I think useful and quite interesting. I'll mention briefly the childcare support, which was all announced the day before the budget, and the limit has gone up to £8,000 per child, and this is actually going to be operated by a single provider on behalf of National Savings and Investments. So it'll be a government savings scheme, and 20% tax will be clawed back from the government on any amounts that eligible parents save. It was thought that the employer £55 a week allowance would go in order to finance this, but that is going to be left open. However, it's likely that most staff will move across into this childcare support scheme. On capital gains tax, not a lot going on. The index exempt amount will be £11,000 this year and £11,100 next year, and a couple of changes to rollover relief. There's been some debate and confusion about some tax law rewrite measures, so changes made to clarify that intangible assets are not a rollover item, and then secondly to bring in a new class of rollover asset, that is the new agricultural subsidy rights under the redesigned scheme. And that's just mirroring what we've always had going back as far as milk quota. On IHT, the nil rate ban has been frozen through to 2018. That was announced a little while ago. We've got a possible exemption for members of the emergency services killed on active duty, and an extension of the anti-avoidance legislation introduced last year, which saw debts in the estate disregarded if the proceeds were applied to purchase certain non-chargeable assets. That's going to be extended to cover foreign currency bank accounts, which are also exempt in the death estate. Some developments on the property tax measures introduced last year, and really the extension of that area into a new, much lower cost base. So we'll be bringing the 2 million measures down over a period of 2 years to £500,000. For SDLT, the change actually happens for relevant transactions from budget day. So to be clear, if a non-natural person buys a property valued at more than £500,000 from budget day, then the tax rate, the SDLT rate, increases to 15%. As far as ATED or ATED is concerned, the annual tax on envelope dwellings, that will be extended to properties valued at £1 million from April 2015, with an entry point of a tax charge of £7,000, and then down to £500,000 from April 2016, with an entry point tax of £3,500. Government has also announced the indexed amounts for the 2 million plus range, which have been indexed by inflation. And on property, don't forget we've already had announced the personal private residence relief final period will reduce to 18 months from April, and PPR disposals by non-residents will be taxable from April 2015. In fact, all residential disposals will be taxable at that point, but only for gains from that date. Finally, a couple of tax admin points, some stuff around administering the Scottish rate of income tax, which is soon to be with us, arrangements to collect Class 2 NIC with self-assessment tax from April 2016, so quite a wait for that, and then a rather shocking announcement that from 2015, HMRC intends to be able to collect debts of more than £1,000 direct from taxpayer, bank and building society accounts. Clearly, they've already said there'll be safeguards, and it's something that I would think the tax and accountancy bodies are going to be watching very, very carefully indeed. Well, that's my quick roundup of personal tax in Budget 2014. This is one of a number of lectures on the budget content, and I hope you found it useful. Thank you for listening.